Welcome to REFI TV. I'm Samantha Rowan, and my guest today is Russ Appel, a founding principal of the Praedium Group. Welcome to REFI TV, Russ.
Thanks, Samantha.
To start out, could you give us the 2-minute overview of Praedium and its investment strategy?
Sure. Well, Praedium is a 23-year-old private real estate equity firm. We're based here in New York, and really we've been focused on underperforming, underpriced assets really since 1991. And that's really what we have focused on.
What I'd like to talk about today is a white paper that Praedium just put together with Maximus Advisors. It had kind of an interesting focus about the potential tax pressures on a state, local, and federal level, and how those could affect U.S. migration patterns. As the housing market recovers and taxes rise, will we start to see individuals moving from one area to another part of the country?
Yeah, I think this is specifically the research that we were interested in, because as we look at the kind of broader real estate markets, obviously demand for real estate is impacted by bodies. Mm-hmm. And so one of the things that we've been thinking about, particularly with federal income taxes going up and fiscal pressures on all of the municipal and local governments, how will those pressures ultimately impact demand for real estate, and ultimately how will that sort of affect fundamentals of real estate as kind of a large real estate investor investing across the United States? And so we have been investigating, doing some research, and in fact our research sort of proves out, or at least indicates, that basically it is likely that people will move from places with high taxes to places with low taxes, particularly as the housing market starts improving. We actually have been looking at this for several years, and while we've seen a correlation over that period of time, actually we think that it will even be more impactful, meaning there'll be more migration affected by taxation as the housing market recovers, because right now we believe that there are a number of people that are underwater in their homes and would like to potentially move jurisdictions or relocate, but can't afford to right now. So as the market recovers, they'll be more able to afford to. They no longer will be underwater in their homes, and we'll see this even strengthen more and see more migration. But yes, we think that we'll see people move from high taxation areas to lower taxation areas.
Sure. There was one interesting part of the research that really jumped out at me, and it was the segment about the impact of unfunded pension liabilities. And I was wondering if you could talk about how that is going to affect commercial real estate.
Yeah, well, again, if the theory is that people will move from higher taxed areas to lower taxed areas, one of the things we were looking at is where are future taxes potentially going to be. And so what we did is we did look at current tax rates, both on businesses and to individuals, but then we tried to look for potential predictors of what tax rates may be in the future. So when we looked at the economic health of many of these municipalities and states, we also looked at what their potential liabilities could be, and potential future health costs, retiree health costs, and quite frankly unfunded pension liabilities would put pressure on the obviously the fiscal capabilities of those jurisdictions, and we thought may lead to higher taxes if you had higher unfunded obligations or higher liabilities going forward. And so yes, we looked at that more as a predictor of the directionality of tax rates. And so again, when we look at investability in real estate and the impact on real estate markets, obviously we're not looking just at today, but really, because you own real estate for longer periods of time, we're really trying to look in the future and trying to be somewhat predictive. So if the theory is people potentially move from higher tax jurisdictions to lower tax jurisdictions, and by the way, that's not the only reason why people move, but it's just an influence, and if that's a theory, you have to look forward. And we looked at potential liabilities, included the unfunded pension liabilities and potential other health care costs, as somewhat being potentially predictive of directionality of future taxes.
Have you identified any areas that could see a migration out as a result of these taxes? And on the flip side of that, where will people be going to?
Well, in terms of this research, it's really focused primarily based on taxes. And so we were trying to isolate kind of issues relating to taxes. So we clearly looked at places that had kind of higher taxes and places that had lower taxes, and then sort of looked at potential liabilities in that direction. Obviously, there are other factors besides taxes: climate, lifestyle, jobs. Obviously there are certain areas that right now the energy and technology industries are doing better. So areas with stronger, influences by those industries may be attracting people because of the ability to get jobs there, not just taxes. But yes, clearly a kind of directionality. What we were looking at was people potentially moving towards states that had lower taxes. So, for example, now we also looked at what we called investability, i.e. liquidity in real estate. So there may have been some markets with very low taxes. From our perspective, if there's not a lot of institutional real estate transaction activity, that was less part of what we were looking at. But so, for example, states like Washington, Texas, Florida were all states that had relatively low tax cost, and as we looked at their liabilities looking forward, we thought were also predictive of continued lower tax costs, and we thought, as examples, those were markets that may get more migration, more people coming to them, and as such, potentially more demand for real estate. And when we talk about demand for real estate, more people ultimately means more demand for all types of real estate. Obviously, it affects multifamily. It affects office, it affects retail, because as people come, they buy things, they live somewhere, they want to work somewhere, so it affects across real estate. So this wasn't really specific to asset classes, but was really talking about demand for real estate more broadly.
And now that you have all this data and research, how do you factor this into your investment decisions?
That's a very good question, because obviously when you look at investment decisions, you have to look at pricing. Obviously, you look at growth. And quite frankly, this is just one factor that could influence us. So for us, it doesn't drive our investment decision making, but it is an influence, and it is a factor that we want to think about among many other factors. In the paper we put out, we actually did sort of a theoretical analysis where we sort of did a 50% weighting to Maximus as sort of normal supply demand for markets, and 50% weighting with respect to sort of a potential migration relative to taxes. I don't know if it is that influential in our decision making, but clearly it's an influence. It's something we think about. And again, what we're trying to do is we're trying to be cutting edge in thinking about, where is demand going to be greater for real estate, and obviously to the extent we can find things priced appropriately, invest in those markets, and where is demand going to be not as strong. Obviously we have to factor in supply as well, and in the markets where it's not as strong, to the extent we want to invest there, we have to factor that into our pricing, because we are a kind of a very bottoms-up investor, and then look at the top down as well. But it starts with us from the bottom up.
Sure, and one of the things that I found interesting about this research as well is that it comes at a backdrop of kind of a larger change in the U.S. commercial real estate market, where some cities, like you mentioned in Washington State, for example, like Portland and Seattle, are seeing tremendous growth as more companies relocate there. And it seems like we're also seeing like kind of a broader corporate relocation to different markets than have traditionally, been.
Well, I think you're right. I mean, I think there are times in the real estate cycle where sort of all things lift in a rising tide, and to a certain extent in the sense that we've seen more liquidity come into the market since 2009. To a certain extent, we have seen that, at least in terms of valuation, to a certain extent. In terms of fundamentals, we have not seen that as much, and as you're suggesting, that regionality is more important. And clearly, so far, what we've really seen is kind of strength from energy and technology industries, and clearly kind of locations with a larger presence of those industries in general have been doing a little bit better. But I think also we're going to see other factors influencing regionality, and I think something like migration patterns and potentially an influence of taxes on migration patterns, again, could be something that regionally could be very predictive in terms of ultimate real estate demand.
Now, to shift gears a little bit, I'd like to talk about the sectors and the markets that you think are the most attractive right now, and
sure.
Where are you guys seeing value?
Yeah, well, you know, I'll be upfront with you. In terms of Praedium, I mean, we've been big investors in the multifamily sector. And for the last, really, since the recession, that has been the biggest area of focus. I would say we have taken advantage of distressed opportunities outside of the multifamily sector. But our main focus in terms of the fundamentals of real estate, and we were, I'm going to say we were early. I mean, historically, for our 23-year history, we have always invested significantly in that sector. But I think particularly over the last 4 or 5 years, it is the area where we have seen, we had sort of focused because of the fundamentals, because of the demographics, because of the demand. And so we have really, as opposed to regionally, we have really focused primarily on that sector, and we have been in that sector big investors in places with technology and energy industries. So we have been investors in Northern California, we've been investors in Texas, we've been investors in Colorado. So we've been sort of in many of those markets.
Thanks for that. Unfortunately, that's all the time we have for today, so I'd like to thank you so much for being here, Russ.
Thank you for having me.
And I'm Samantha Rowan, and this is REFI TV.